So if you've been following for a while, you've seen me draw boxes a lot. There's not always a box, but when there is, it does make for some great trading. And a lot of times I will try to front run a breakout of a given box and with a swing. And so if I can enter perfect entry, let's say I take the reclaim of last week's low, or maybe I take the reclaim of Monday's low, right? If I'm going to stay in, to the top of this box and then for a breakout, because once it confirms breakout, like I'm making a lot of money and like I'm good, right? But this is the part that can be problematic, right? While we are still here and currently, we're stalling at the top. And so I've been saying a lot lately, like hedge the edge. And so to me, that could mean a couple of different things. And it's not just if you're trying to swing, it also could be a day trade. If you can readily identify the edges, and that's my job, it can become very, very helpful. Because the thing is, right, we've all been there. We get in a great trade. We're making a lot of money. We're planning on holding this into January until ES hits 6969, and we're going to be rich and it's going to be great, right? And then we come up here and this happens and you're like, oh, well, shit. And then you close everything, right? Or maybe you make it up all the way up here and you see this rejection and you say, well, shit, and you close your position. So what I like to do is hedge the edge, right? So let's say I do get into this long on either of these trades. What I will do is, let's say I'm in January calls or maybe December calls, and we start coming up here into the top and I'm reading price and I say, well, you know what, like I'm going to take, first of all, I'm going to probably take profits on something. Like even if it's 10% of my position, I'll take profits and then set a stop for even on the rest because I don't like losing money on trades. I'm more willing to give back unrealized gains, and you have to be in order to catch and stay in a very big trade, but nobody likes it, right? I mean, if this comes back down even halfway, like you're all of a sudden going to be uncomfortable. And if you think about it, if it comes back halfway and this is a bullish market and we're going higher, you should be buying there, right? Not puking your position. And so when we get anxious and we get afraid of giving back gains, that's when we make bad decisions. And so for me, let's say I take off 10% of my position, but I really don't want it to come all the way back against me. I might consider, and again, in the example I'm using options, maybe I take like a 1 week out put against it, right? Something low delta. So if it stops me out, it doesn't really hurt that bad. It's like pennies. And I'm not taking this like with the same size as my primary trade necessarily. Like I'm just looking to have something specifically lower delta, shorter dated, because it'll move faster, right? So like this long, if let's say we pull back to here, and this comes back down 50%, well, I mean, a 0-day option is going to go like 1,000% from here. A week out's probably going, 100% depending on the option, right? And so you can take a smaller size, get a larger return off of this hedge. And since it's lower delta as it goes against you, it doesn't hurt. Now, if your pattern day trade account, then like you don't want to just be, taking a hedge and then stopping on it as we break above here and then taking another one and then stopping, and then all of a sudden you're out of day trades. And that's where ES options are nice because they don't count for pattern day trade rules. So that would be an option. And that's, if you're trading like SPY calls, you could take an ES put against it and that wouldn't impact your day trades. If I'm trading, full size ES up here, maybe I'll take a MES short against it. Or again, maybe it'll be ES puts against it. There's just a number of different ways you can do this. This could be SPXL up here, and then maybe 20% of your position you take SPXS. Like there's just a million different ways that you can accomplish the same type of thing to potentially keep you in this trade longer, because like I would rather miss out on a couple of handles, even like twice, right? Because let's say I'm going for new all-time highs, like we still have a long way to go. And if you think we're making a higher high, you might still have 200 handles to go from here, like from the breakout. And so giving back like 2 or 4 doesn't bother me quite as much. Now, again, that requires you to identify the edge and then to be able to read the price action to determine if you should be slapping on that hedge and when it's appropriate to pull it off. But again, like, so what if you give back 2 to 4 handles and this trade goes against you? It's going to feel a lot better. You're not going to care, right? If this just rips 200 handles, you're not going to be thinking like, well, shit, wow, what an idiot. I gave back, those 2 handles with micros or something like that. You're not going to care. But if this comes halfway back, and certainly if it comes all the way back, you're going to feel like an asshole completely, right? And you've just wasted, both mental capital and actual capital seeing this trade reverse all the way back to your break even. So that's just something that I like to do. It's not for everybody. It might be a little bit of over management of a trade, but if you can identify those edges, it is definitely a way that I am able to hold much longer, because this is how I like to swing. I like to identify these ranges of consolidation. I like to take a look below and fail if I'm looking for a long. I like to take a look above and fail if I'm looking for a short. So I mean, this was an okay short to attempt to swing. And that's how I like to get into a trade. And then from there, once I get the confirmed breakout, like I don't need to even take profit if I don't want to, because the trade is good. Hope everybody's just making a ton out there.